Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes driving markets at the moment. Whilst I just let you have a quick read of the disclaimer, I'll just briefly run through the format for today. Quite a lot to get through, actually, a lot going on in markets, quite a decent move actually to kick off the week this week. Firstly, we'll check out some of those drivers, actually, sort of wider drivers potentially for themes influencing markets at the moment, potentially the Ukraine war and this pushback by Ukraine, actually, and Russian forces pulling back. We'll also just touch on prices, actually, and a few instances of inflation potentially and price pressures really easing. We've written about that in our daily. Hopefully you're getting that and reading that commentary, but we'll just touch on that as a theme, probably a wider theme, not a tradable theme as such, if you're more short-term in nature, but something to look at on a wider basis. We'll look follow the usual formats, actually. So yeah, these drivers, and then also then Wall Street sort of technicals on some of the major equity indices in the US. We'll also look at the DAX as well, that we have been doing over the last few weeks. We'll then briefly review the ECB meeting and look at euro dollar and also euro yen technicals. Quite interesting push higher in the euro. And then we'll briefly focus on Canada data, actually, the Bank of Canada as well. We had some jobs data out on Friday worth just running over. And then we'll obviously get to the main event for this week. That's, of course, the US inflation data, US CPI data out tomorrow. And we will look at the dollar, of course, and hopefully then finish up with UK data this week as well, sterling, and a couple of other major currencies, as well as hopefully looking, actually, whilst we're looking at US CPI, we'll look at dollar yen and also gold, just some of the technicals there, which we actually wrote about on Friday as well. So firstly, just a brief look quickly at markets at the moment. The dollar obviously is pulling back from those highs we saw last week. Let me just take off the counter channel. This is the DXY chart here. But in general, yeah, the markets are kicked off pretty positively, actually, holding on to those gains that we saw last week. As I said, this follows really similar advances in the holiday-thinned Asian session. China and Hong Kong, they were or are away on an extended weekend. But US equity futures as well, they're pretty positive, up 0.45%, looks like the S&P 500 futures. And it's really geopolitical headlines are garnering quite a lot of attention, really, as Ukraine, as I've said, reportedly makes quite big progress against Russian forces. Yeah, this is a sort of general theme, I think, just thinking about the Ukraine-Russia story. I think in less than 5 days, Ukraine has managed to retake more territory than the Russian army could occupy in 4 months. So potentially something to bear in mind here as markets push higher, quite positive, especially in the euro. It's probably too early, really, to call a turning point, of course, but as many really consider sort of a frozen conflict, if you like, as the main scenario, at least in the short term. But generally, I guess if we think how the markets have been looking at this situation over the last few weeks, couple of months even, it's sort of this ugly standoff we've had between Russia and what potentially Russia gets out of the conflict, and whether then they're discouraged from trying any further aggression, and that has kind of appealed to markets in general. It's sort of taken a step back, really, from the main events of the conflict of the conflict, and that sort of scenario implied some kind of excuse for Europe to kind of potentially lift sanctions further out. That would ease the energy crisis, but of course still limit Russian impunity, if you like. So the implications potentially of this sort of more resurgent Ukraine are probably harder really to gauge, but quite interesting dynamics here as they make gains, as we've said, over the weekend especially. This sort of changing situation, it does add to uncertainty potentially, and there are just so many questions really when you think about it. You know, do we get a peace deal entailing territorial concessions for Ukraine? Or are Russian troops pushed back further behind the pre-war front line? And then there's no territorial concessions really for them on that side. And potentially then, do we get some sort of Russian ramp up in forces, not to lose face, and a real increase in bombardment potentially? There are stories of them hitting energy supplies, and water supplies, I believe, to some of the major towns. And then does this also, another question, does it give increase the incentive for Russia to just cut off energy supplies to Western Europe? So a lot of questions still unanswered, of course, in conflict, very difficult to predict really, but some interesting positive headlines over the weekend. And near term, well, at least we've seen this sort of sharp turnaround in the dollar, really. That started at the end of last week. You can see on the daily chart here, after this sort of decent ramp higher, that break from consolidation above the 109.29 level there, which is the previous mid-July high. And we sort of stuck around there for quite a few sessions, that multi-year high at 110.78 really. But since then, we're on a fourth day of declines, quite rare for the dollar, as we said in the last few months, been a fair procession really. We've said there's no real alternative, and there probably still isn't really, with growth still impacted in the other major economies of the world. But yes, important to watch this potential rollover, small rollover, whether it's profit taking or not in the dollar, the DXY. We also probably had the combination on Friday last week, especially of slightly more hawkish central banks elsewhere. Obviously, the Eurozone we'll touch upon, and the ECB, and then also this potential intervention by Japan, which is possibly closer. I think just the second theme, as I mentioned, worth looking at is around inflation. We touched upon it in some of our daily commentary, really, and that's outside of the sort of gas and electricity space, if you like. It's just price pressures are sort of actually easing, especially when it comes to inflation on the goods side. So you've seen, obviously, oil prices, they dropped below $90 in Brent, actually. We're above there now at 93.19, but they did drop below 90. That was the lowest level since January, and that came despite actually a cut in oil production by OPEC plus members of the 100,000 barrels. And oil prices, well, they're down sort of around 30% from the peak in March. And we also got last week probably areas that, you know, not many sort of amateur traders look at potentially, but are just pointers, and it's around lumber, it's around freight rates. I think they dropped freight rates another 15% last week compared to the week before, and that's sort of taken back more than half of the sharp price rise that we saw in 2020 and 2021. So they sort of reflect weaker demand in the US and Europe, with less sort of pricing power amidst weaker sales and high inventories. So potentially that contributes to lower inflation in goods prices. And then it's just whether we get inflation on the services side. So that's probably to do with labor markets, not trying to get too deep into economics here, but that's to do with the slack in labor markets potentially bringing down wage growth. But of course, until we get that, then central banks are still going to keep tightening until there are these signs that potentially labor markets are softening. or turning at least, and then that's where we get goods prices potentially we had goods prices falling, but then we get potentially weaker demand affecting inflation elsewhere, services inflation that is. And then if wage or labour markets do turn, potentially we're sort of seeing that Goldilocks scenario actually in the moment at the moment in the US, but potentially there is that slowing pace in jobs growth in the US, potentially moving elsewhere. So something just to bear in mind, a wider theme. We like to track markets by themes and narratives. We have done consistently, and that's just one to remind yourselves about and think about longer term. Of course, near term, this week we're gearing up for tomorrow's US CPI report, of course. That follows, as I said, that Goldilocks sort of US jobs data, not too hot and not too cold, really, is when people refer to a Goldilocks report. That's what it means. We've also had some fairly positive manufacturing PMIs, ISM really in the US, and then some constructive Chinese inflation numbers as well in recent weeks. And for risk markets, essentially, when we talk about that, we talk about S&P, the NASDAQ. They've recovered actually from, or recovered some of their declines since mid-August. Both indices finishing the week higher last week, up around 4% or so, I think, in the end. And that was in spite, actually, of hawkish remarks from Fed Chair Powell. And also that big interest rate rise in the Eurozone. So quite interesting that stocks pushing higher at the end of last week and into this week as well, potentially futures looking that way. The weekly gains, actually, that ended 3 straight weeks of declines in the S&P. You can see there the 3 candles, 3 down weeks, and then last week's very decent, more positive candle. You can see that on the weekly. We always like to do that. And then let's drop down into the daily. Just take off some of these indicators. This is the RSI, back to 50, interestingly. So neither overbought nor oversold, bang in the middle, really, from that sort of lower figure that we got around the mid-30s there for the daily RSI, that is, and now back to 50. So we're sort of back to back to the 50-day moving average. That's that light blue line at 4,030, and then also the 100-day moving average, pretty much the same level, 4,031 there. You can see that light grey line. So we're back to the 50-day and 100-day moving average. Interestingly, that will act as support near term, you can see, because we broke through that. Then I've got this June swing high, if you like, at around 4177 potentially is the next target in this sort of rebound. And then support comes probably from, the lows last week, actually, at around 3886 potentially. If we just look at some of the other indices then as well, the NASDAQ, this is a NASDAQ 100 we always focus on. Just looking at the weekly, you can see that I've got a bear channel, really long-term bear channel from the highs back in, well, November, December. You can see that channel there. We broke out of it briefly, as we've mentioned before, a couple of weeks, but then pushed back down into it. We're sort of trapped potentially between, well, the black line is the 200-week moving average, offering support there, and then the top side is the 100-week moving average. So the 200-week is around 11,100, just above, and the 100-week moving average around 13,800 there on the weekly. That's the NASDAQ 100, not the composite. So on the daily, you can see that sort of more clearly, that bust out of the channel and then back in, and then like the S&P, really, 50-day moving average, 100-day moving average, well, above and just below where we are currently trading. The top of the channel probably around 12,800, although the sort of breakout possibly negates this channel, but you just get a general picture, obviously, for the long-term bearishness in equities. And then, yeah, we've probably got support if we do roll back over around the 12,000 level there, where we held sort of last week, 11,928, I think the low there. Just touching on the Dow, I know a lot of people look at the Dow still, very popular trading that. On the daily then, again, 50-day moving average, just above prices actually at 32,206, 100-day moving average at 32,260 there, you can see. So that will offer some resistance probably above. And then I've kept in actually some fib levels here, which are from the year's high to year low, and potentially we've got the 38.2 at 32,441 as resistance. Again, if we do break these simple moving averages before then we get to the halfway point, somewhat above there, halfway point of this year's high down to this year's low, I've got it around 33,300. And then support as a minor fib level before last week's low, yeah, around just above 31,000 in the Dow. I should mention the DAX as well. Always like looking at the DAX, the German main equity index. We highlighted last week actually 12,400 as a key support level. That was the low from March, 12,438, and then the June low was just below there. You can see 12,390. So that was major support. We didn't quite get there actually. We've rebounded quite nicely, and we're above now the 50-day moving average, 13,197, potentially heading up. I'd say into the 100-day moving average, really 13,481, and then we've got this long-term trend line resistance from the highs back in January. You can see touch 3 points, so quite significant that will be, you would think, as resistance around 13,600 there, 13,600 in the DAX, potentially capping the upside. Will be interesting to see how far we can get up here. Okay, we'll do a quick recap actually on very quickly ECB last week. We had that trio of central banks, if you remember, the RBA, the Bank of Canada, and then the ECB, really highlighting how much these central banks are in inflation fighting mode, really, despite the outlook potentially for recession. And that's certainly the case in Europe with the ECB. Very hawkish, really, on the side of taking that 75 basis point hike. Markets kind of thought that was more realistic. Probably Citi analysts, Wall Street analysts, they were going probably more for a 50 basis point rise only. President Lagarde, so the Governing Council hiked by 75 to take rates to 0.75%. She said President Lagarde risk to inflation on the upside, growth on the downside, didn't obviously rule out further tightening. And the projections really, so these are the ECB staff projections every quarter for inflation. They were obviously went higher, but potentially not too high, really, 5.5%, I think, for 2023 against 3.5% earlier. And then they lowered growth forecasts, although potentially these were still seen as quite optimistic, really, for next year, 0.9% versus 2.1%, I think, and then 2024, 1.9% versus 2.1% previously, those previous projections. And they raised actually growth projections for 2022 up a touch. So yeah, many think they're still very optimistic. The ECB heading for a recession into the winter. But regarding 75 basis points, Lagarde, she said that wasn't the norm, but the moves will not necessarily get smaller, interestingly, as a bank really needs to move further towards the neutral rate. And that neutral rate is puts at probably somewhere between the higher end, really between 1% and 2%, but the higher end of that. And Lagarde, she really emphasised that policy. She kind of has to say now they've dropped forward guidance, if you like, and interestingly, then went on to say that at most 5 meetings. The next 5 meetings, including this one, would include a rate hike. So sort of really guiding markets there, even though she kind of tried to emphasize that policy was data dependent still and on a meeting by meeting basis. That was kind of echoing the chief economist Philip Lane's comments from the last week. But yes, as I said, she did guide markets really in saying about the next 5 meetings, which takes us out to February potentially being where we see hikes. We've got 2 meetings left this year in October and December. And it kind of all keeps the door open for potentially another 75 basis point hike. Money markets, they, I'm just trying to think, they price in, they're still relatively hawkish. So they're pricing in rates to around 2%. So that's from 0.75% now. So that means another 125 basis points of rate hikes between now and year end. 2 meetings, as I say, left in October and December. Sorry, the 2% mark is further out, actually. It's 1.75% by year end. Money market is pretty much pricing in. So potentially a bigger 75 basis point move. I think that's around a 60% chance now, just above that, actually, currently for the October meeting. And then you get actually pricing, as I've said, above 2% into next year. So interesting what happens, obviously, with the ECB going forward, potentially as we get into that October meeting in the next few weeks, whether markets do really solidify that bigger rate hike. For euro dollar, well, we can see what's happened recently. Obviously, we pushed up now above the late August high there. That was at 1.0090. You can see that high there, around there. We just pushed up above that just now, actually, and also the 50-day moving average at 101.12 or so. But we do have this trend line resistance, so that goes back to similar to the DXY, actually, to February, those February highs touching a number of points, actually, so potentially quite significant as the first level line of resistance. You can see, actually, we touched it today, 101.97, the high today, and then we've pulled back 60 pips or so. So that will act as resistance for sure, the trend line resistance, the trend line there, the bearish trend line from those highs in February. If we do manage to break that, then we do have this 100-day moving average sort of tallying with the August highs around sort of 103.38, 103, where are we? 103. Oh, we're a bit higher, actually, 103.60. But so between 103 sort of 38 and 103.60, really the next level of resistance, if we can break that trend line, downward trend line, which has proved initial resistance so far. Otherwise, we get back into sort of the the parity level again, as being sort of key support, looks like, for the time being, potentially. I did say we'd mention actually euro yen as well. If I just go down to euro yen here, just an interesting sort of level that we're getting into. We pushed much higher actually today through this sort of June and July resistance at 114.25. I have it around there, a zone. We sort of consolidated just below there late last week, and then pushed very sharply higher, actually 145.63 the high, but then you see we've pulled back towards that level of resistance, possibly support. Interesting levels there. You have to go back to December 2014, I think, if we go to the monthly. Yeah, here we go, back to here, December 2014 for the next level, potentially. The monthly high there was 149.78. So key level, really, you think on the daily, really around 144.25 and above, whether that acts as resistance again, whether we can close above there today and then potentially push higher or not. That's in euro yen. with the euro, of course, we always have to mention the key driver we've showed you in the last few weeks. Obviously, gas prices, they've taken center stage over the last few weeks. That followed, obviously, the closure of the Nord Stream 1 pipeline. And just worth mentioning, actually, governments, EU governments, that is, meeting. They met on Friday, really trying to concoct, scrambling, really, to come up with measures to cap bills, like in the UK, guarantee credits for utility companies in need of liquidity due to the price hike, of course, the spike higher really, and then also power saving measures in public sectors, really. And EU energy ministers, they did meet on Friday to coordinate policies, and I think they endorsed 4 or 5 initiatives, so not every initiative, really. And it's interesting, a point to make actually, that the policies in many cases to mitigate these costs aren't fully funded. So that means fiscal policies really then again are being eased, and all else equal, then that would require more monetary tightening to compensate for the fiscal easing in order to get inflation down. Really important point there, potentially for the ECB. Of course, electricity prices, they're down actually around over 35%, I think, from the peak in August. That was at the end of last week, actually. But the EU President von der Leyen, she speaks actually on Wednesday, and she'll outline what measures have been agreed so far in the Eurozone around all these energy measures by different governments. So that might be a key focal point for markets potentially. And then it also potentially these measures may allay fears around the euro recession, which many economists are predicting for the Eurozone. Just stepping back to Canadian data I mentioned, and the Bank of Canada. That came, well, we had the employment data on Friday, I'll just touch upon in a minute, but the Bank of Canada meeting, obviously, after their latest rate increase, that was a 75 basis point increase after the 1% increase in the prior meeting, which was a surprise. The 75 basis point hike was really in line with expectations. And we think it's notable, really, that policymakers still have pretty clear focus on this, still building the core inflation pressures and also elevated, elevated inflation expectations. And following that policy decision, actually, we had comments from one of the deputy governors, Rogers, who noted the economy remained in really a state of excess demand. And the Bank of Canada was still really a long way from where they need to be on policy. So hawkish remarks from him. We then, that said, we got a slightly weaker Canadian jobs report. The headline certainly was weaker. A fall in jobs around 40,000, I think, driven by a loss, quite a big loss in full-time positions. The unemployment rate rose to 5.4%, I think, from expectations of 5%. But what was interesting, actually, in this jobs data report, probably quite important in the current environment, hourly wage growth, they rose to a new cycle high, actually, 5.6%. That's a series high outside of the pandemic. So quite hot wage data there in Canada, and potentially just bolstering these expectations for after front loading, at least probably a slight downshift, but still 50 basis point hikes from October onwards by the Bank of Canada. And for dollar CAD, well, that's been trying to break away actually over the last few weeks from this broader pull of risk appetite and general tone of the dollar. And we can actually see it in the last few days. This is dollar CAD. So the dollar has obviously been strengthening. We highlighted, I think, before this resistance level around 132.23, that spike high from July, and potentially we have struggled again through there, and we've rolled back down. Near-term support, again, the light blue line, 50-day moving average, 129.53 or so, potentially moving down below 130 then towards that level. But certainly 132.23 again reinforced, couldn't get there a couple of times last week and the week before. So a major level of resistance for dollar CAD, potentially rolling down towards 130 and then 129. Don't get a lot of data there actually this week, but obviously the US CPI data will be key. Let's look at that now. The main event of the week for sure. If I just pull up a graphic that we use from time to time, you can see here, this is a preview actually, sorry, there's a slight error there. So it's a preview of the data expected to tomorrow, get tomorrow. Yes, so headline inflation, and really, yeah, headline inflation due to drop from 8.5% to 8.1%. Range of estimates around, I think, 7.9 to 8.3. And then that's brought about by this drop in month-on-month headline inflation. This is a drop of 0.1%. That would actually be the first decline since May 2020. But it's this, what we will get potentially going forward, the difference between headline CPI and then also core CPI. Core, remember, that strips out energy and food, and those volatile elements, and they're potentially still rising slightly as headline comes off. So something really key to note, probably core inflation really giving us a truer read of the risks potentially going forward. And you can see, yeah, I've said 0.1% decline in headline, but then the core month-on-month reading rising, consensus sees that rising to 0.4 from 0.3 before, and the 0.3 being well short of the 0.7 reading in June. I've just also got a chart here. This is Bloomberg surveys, really. The white line is the current US CPI core, that is, so stripping out energy and food, and the light, so it's the white line, which is currently what we see, and then the other lines really are the surveys, so the high and the low, and then the average being the blue line, so potentially pushing above 6% for the core CPI annual reading. Really interesting, obviously, what the market reaction will be. But with this, yeah, so this difference, I can't highlight enough, but the difference between headline CPI and then core CPI, we might get this divergence, headline falling and core CPI potentially rising. Just on from that then, potentially, yeah, just to highlight, actually, we did get Fed Chair Jerome Powell actually speak last week. He stuck to the fairly hawkish line by most Fed Reserve members. We have been hearing from them over the last few weeks, basically suggesting a 75 basis point rate hike at the September meeting due to these inflation, elevated and sticky inflation, really. Powell, he noted that the labour market is very, very strong. Wages are elevated, while also signalling actually that growth will likely fall below trend. But all their focus, all Fed speakers, all Fed members' focus is on getting inflation down. And certainly on inflation expectations, that's the key concern for Fed officials. Powell actually said they are well anchored over the long term, but really the clock is ticking, and the Fed has more concerns that potentially the public will incorporate higher inflation expectations in the short term, and that's their key focus. I just probably will check in on one of our favorite websites, CME Group, watching Fed funds futures actually, and that shows us what is priced in for the meeting next week, the 21st of September meeting. 88% chance now of another 75 basis point rate hike pretty nailed on, you'd like to think. So then ally that with the CPI report. Really does have to be a significantly softer print to bring these odds down below where we think is sort of the guide 70% or so. Anything above then the Fed doesn't really like to upset money markets. So really we're nailed on here for another hike. Should really support dollar strength in the medium term, with the Fed still in quite aggressive hiking mode, potentially. And I guess for the CPI print, anything below, say the headline below 8%, that might give a sort of slight psychological lift, if you like, to risk markets. And that means the dollar will sell off, and then gold and say the NASDAQ risk market, key risk market there, should really get some kind of relief rally if we get the headline below 8% or so, whereas the core, if that sticks around 6%, just a sort of relief rally, you would like to think. Of course, if inflation remains high, then obviously we'll get a leg down in equities. Dollar will push higher. Just worth looking at further out then, the terminal rate. This is the end rate for Fed funds. Really now, just to show you how much higher we've gone. We sort of backed off, didn't we, with the Fed pivots in the summer months, and now we're sort of getting towards the 4% level. This is the 4% to 4.25% really, and you can see sort of chances of that have increased. If you look at here below, 49% chance, really 3.75 to 4%, and that's from a month ago where there's only a 26% chance of that happening. So sort of doubling in chances of rates going there. And even then, this really highlights it, I think. Sort of 4% and above, so 4% to 4.25%, only a 5% chance last month, a month ago, and now we're up to 37% chance or so. It's quite interesting there, and this probably shows it as well further. If we go to March, again, we've sort of shifted from sort of 3.5% or so, which was 37% a month ago, now 5% only for the 3.5% marker or so. And we're getting into around a 4% end rate for the Fed funds. And we're currently, of course, at 2.25% to 2.5%. Worth looking as well. Then we said we'd look at dollar yen. Been a huge mover, had grabbed a lot of the headlines with this drive in rising yields, 10-year treasury yields, key correlation dollar yen does have to that. And then obviously this contrast, if you like, between the aggressive Fed we've shown you, and then still this ultra dovish, really, Bank of Japan. They're still trying to cap 10-year JGBs, 10-year Japanese government bond rates at 0.25%. Don't forget that. So that, along with the worsening terms of trade in Japan, as the country, remember, is a big net importer of energy. So that's pushed dollar yen, of course, up to levels not seen since August 1998. If we look on the monthly chart here, and that break actually, which was key, obviously around 135, everybody was looking at before. And then, going back to around, where are we? August 1998. And the level there, 147.67. So that was really a level for bulls, but we've just sort of come back off 145. We had that meeting between the Bank of Japan, the FSA, and the MOF, the Ministry of Finance, convening late last week, and that sort of put a cap on prices. Really, 144.99 was the high, and we just sort of rolled back over slightly towards 142 yesterday, Friday 141.50 actually the low, and now we're around 142. So this will move certainly on the US CPI data on Tuesday, on tomorrow, And then also, obviously, gold will potentially move. And that's certainly been driven recently by the sharp move higher in treasury yields, in bond yields, impacting gold. Obviously, that then falls. And then we've obviously had that higher leg in the dollar as well, impacting gold. We didn't get quite to this key support level we see. That's the August 2021 spike low at 1677. Didn't get quite to there last week and the week before, low at 1688. So though sort of near-term support, and we're pushing now up to first level of resistance, 1742, the 50-day moving average. And then you can see the bear channel that we've drawn here, sort of long-term descending channel, if you like. And where does that come in? Break above, we need to break above, say, 1750 or so to potentially break out of there, but then we've got resistance levels above. So sort of long-term bear channel, as we say, for gold, and we're still pretty much stuck in that. Right, we'll just touch on some other events to look out for, which is the data in sterling. We had GDP today. Actually, expectations were for quite a large bounce back actually from June because of that addition of the extra bank holiday, which would have distorted the monthly numbers. But we actually got quite disappointing numbers, 0.2%, I think, so lower than expected. But we have to bear in mind these bank of holidays, they do throw data out really, and it's kind of tough to read those figures. And then also then going forward, we have a bank holiday week today actually for Queen Elizabeth II's funeral. So we might have to look actually further into Q4 actually for a better read on how the UK economy is doing in terms of GDP. But of course, we've had that announcement, I'll touch on it, the announcement of energy, the price guarantee by the government, and that certainly does reduce the risk of a deep downturn and potentially also a technical recession. Tomorrow we get jobs data out of the UK. Hiring demand is falling, though the jobs market kind of remains relatively healthy. Expectations for the unemployment rate to remain stable. So just watch probably weekly earnings to see if that supports possible sort of higher inflationary forces, I guess. Again, that announcement of the energy price cap for businesses, especially, that should help limit otherwise what could have been more immediate sort of rise in redundancies potentially as businesses, as firms' costs increased. But then the most important data really for the UK is inflation, which comes on Wednesday. Again, headline and core differences potentially. We had a 6% fall in petrol diesel prices through August, so that will drag on the headline inflation rate, bringing it slightly lower. I think it sees it actually, well, unchanged potentially around 10% or 10.1% actually, range of estimates. Quite wide actually, 9.7 to 10.8%. So just bear in mind that big fall in diesel prices, petrol prices. But again, it doesn't mean we're past the peak. In fact, though the introduction again of the energy price cap, that should probably we won't see inflation surpass probably 11% in the autumn. If you remember, though, there have been these wild, quite well, not wild forecasts, but potential forecasts of inflation going above 16. 18, even 20%, Goldman Sachs, I think, estimated in the new year. So again, the introduction of the energy price cap means that probably takes off around, I think economists estimate around 4 to 5% off inflation in the medium term. So 11% or so potentially the peak in inflation, but really something to watch out for with these measures by the government, and how actually short-term or long-term they are potentially. I think it will make a difference this summer, this winter, the outlook this winter. I think average energy household costs in the UK are now capped at around, or potentially will be capped around £2,500. That's actually for the next 2 years. And when you also factor in existing support, I think there's a £400 support as well coming to households, then bills should stay roughly as they are actually for the time being. Businesses, they get similar support just for an initial 6-month period. So that should really limit the depth of this winter downturn everybody was and is expecting. Should really give a slightly better growth profile for the UK economy. And then it's potentially whether the figures, whether they avoid this technical recession as well. For markets then, we should have had the Bank of England meeting this Thursday. That's now been postponed to next Thursday now. And I should highlight actually around a 24-hour period, I think we get a multitude of central bank meetings actually. So that's next Wednesday, next Thursday, the 21st, 22nd. We get the Fed meeting, obviously, Wednesday night, UK time. We then have, I think, the Bank of Japan meeting, early hours of Thursday. We have an S&B meeting, so Swiss National Bank meeting as well, Thursday. And then the Bank of England meeting being the major G10 central bank meetings, as well as others, I believe. So really something to watch out for. Volatility next week for sure. Bank of England pricing for money markets, I think, is around above a 60% chance of actually a 75 basis point hike next week. Although many economists, I think more realistic is a half point, 50 basis point rate hike at the meeting next Thursday now. So for sterling, interestingly, this is sterling against the dollar. We did push just below key support, which we had at 114.09. That was the pandemic low, I believe. If we just pan out, yep, you can see it there. Spike really lower. On the daily, 114.09, we breached that, I think 114.04, 05 last week or so. Bit of indecision really, or base building, whatever your viewpoint is. Then we've broken, obviously, through this 1 month bear trend, if you like. Quite interesting. And then that trend line resistance actually broken above there, above 116 then. Yeah, pushing up towards 117 now. We've got the mid-July cycle low, the swing low there at 117. Where is it? 117.59 probably is the next resistance level. And interestingly, we did have that sort of pause, you see, sort of late August, just above there. So that probably acts as resistance ahead of possibly 119 as the 50-day moving average. But we're kind of still in this long-term bear channel for sure. Interestingly, it will be interesting whether we get capped really. And that will certainly depend on US CPI, of course, in this pair cable, so sterling against dollar, and what we do near term. We should probably highlight euro sterling. We highlighted euro yen, but for sterling, euro sterling, that's got up to the June highs really. We broke above there actually this morning. 87.21 was the above that actually. Sorry, 87.22 was the high today. You see there, but we've pulled back below sort of that resistance. So that'll be interesting, sort of reinforcing that resistance around 87.21.22 for euro sterling. If we look on the weekly, actually, I noticed the 200-week moving average just around here where we're trading. 200-week moving average 86.98. So 87.22 really key resistance for euro sterling. So really watch out for the data dump this week, especially CPI on Wednesday. Okay, we've covered a lot. Hopefully you've learned a few bits and pieces. No questions as I see it today, but yeah, hopefully keep following us on our social media channels and also our daily commentary, which comes out UK time first, around the UK Open actually. So hope you're reading that and getting further insight into the markets. Okay, good luck, a busy week ahead, and good luck with your trading for sure.